Through the market overview. So it's been a busy couple of weeks. So if you've been following it, it's been interesting from a US perspective. They've obviously had the election. Joe Biden's now been president-elect. There's still some disputes going on with Trump trying to stall it and launching some last-minute frivolous lawsuits, which I don't think nobody in the media really thinks that's going to be very successful. So for all intents and purposes, Biden's won the election. So the interesting thing happened last week. To run up into the election, we saw quite a bit of a sell-off in the market. And then as the first couple of election results came out, the market rallied quite a bit. And the consensus reason for that is that before that, everybody was kind of predicting this blue wave. The Democrats was going to take over the Senate, the House, and the presidency. And they were worried they were going to reverse some of these things that Trump put in place that's helped stocks rally. So some like corporate tax cuts and things like that. So the reason why the stocks have rallied now again, even with the Biden presidency win, is because he's the president, but the Senate is still pretty much tied up. So if you look at the statistic at the bottom there, they're still pretty about 50-50. So what that means is we'll only really know what happens there probably in January, because they have some other runoff elections to finalize the Senate. But what that means is a divided Senate means that they can't just go, and Democrats can't just go and change unilateral decisions in terms of rolling back some of these decisions. And another concern, especially in the tech stocks, was that they were going to impose some sort of policies and things to break up some of these massive technology companies and put some more views into it in terms of exactly what's going on there. What we're seeing at the moment is very much of a sector rotation, so we'll get to that. Before we get there, I just wanted to show you this. It's very interesting. So if you are concerned exactly what's going on with the presidency and how that might affect certain things, it's on my feed, on my wall. If you go to this link, it kind of shows you all the presidents and the effect they've had on the economy. So the interesting thing to note there is, in general, the stock market goes up, whether it's a Democrat or Republican in the White House. But it's pretty interesting just to go and have a look at those stats. Then the other big news that came out yesterday, obviously, was the vaccine, 90% effective from Pfizer. So interestingly enough, South Africa is one of the participants in this one, a combined study with Oxford. So I've been following this one pretty closely. So it's very good that this came out. What we're seeing now again in the market today and yesterday is that some of the technology stocks are selling off. So it's kind of like a catch-22. So which is obviously brilliant, fantastic news that we've got this vaccine that potentially could come out pretty soon. But now a lot of people are rotating out of the technology stocks that had this huge run up, stay-at-home stocks benefiting from what the current market situation was with the pandemic. So the possibility of a vaccine coming out is now obviously a lot of people are now selling some of the stocks. But as a long-term investor, and we'll go through some of those things, it's really not something we should be worried about. So this is what I mentioned. So we've seen some sector rotation. So yesterday, I haven't looked at the markets too much today, but I know the Nasdaq is selling off, so technology stocks are still seeing some sell-off today. But yesterday was quite a brutal one. So we saw some of our biggest holdings, like stocks like Shopify and Fiverr, going down quite big, 13% and 18%, as you can see there. So what's happening is there's a big rotation. So as I mentioned, a lot of people are selling these technology stocks that had a huge growth. They're cashing in, taking some profit, and they're putting in some other stocks that they see could rally now because of the vaccine news. Particularly stocks like in travel, like airline, which we don't have. But we do have stocks in the portfolio, stocks like Disney, Starbucks, which did rally yesterday because of it. So luckily we have some of those stocks also in the portfolio. But as I said, long term, very much still, technology is not going to change. So people are cashing in, taking some profit, but fundamentally things have changed. Like the platform that e-commerce has presented in the US economy in terms of like what Shopify and Amazon are doing, they've pulled forward some success because of the pandemic, but it's fundamentally changed the way people are going to shop and things going forward. So those technology stocks, looking out 3 or 5 years from now, are still going to be very strong. So just to highlight that, so if you look at Shopify and Fiverr just an example, that's been some of the best performing stocks year to date. So even with yesterday's drawdown, Shopify is still up over 123% year to date. up over 500% year to date with yesterday's sell-off. So these stocks have had massive growth, so it's just expected. So that some within the market movements at Wall Street and some these big hedge funds are cashing in some of those profits now and rotating it into other stocks. So just a bit about the portfolio specifically and performance and the strategy going forward. Just wanted to touch on a couple of things. So for me, obviously, if you followed me for a while now, long-term investing is really a key cornerstone of success for me in the market. So what I've put here is just to demonstrate this, and I've put a chart. This is just the S&P 500 for the last 7 or 8 years. So it's been pretty good, right? There's been some hiccups along here or there, but it's basically as good as you could have hoped for. This bull run we've had has been pretty good. So, but with that, even if you could inverse that to have a look at how many times the market has been down over that same period. So if you look at that yellow line, how many times the market has been down more than 5%. That orange line shows you how many times the market's been down more than 10%. And then finally over, 10%, and then finally over 20 or 30%, that blue line. So it's very counterintuitive for some people investing for the first time in this market. How can you make money on something that loses its value so many times more than 5%, or loses value more than 20% so many times? And the rational decision is taking money out of the market because they think obviously this thing is not working, they've made a mistake. But if you look at that long-term trend, and if you zoom this thing out, back to pre-2000, it's just more makes sense in terms of long-term investing. So of course, in that same period, if you look at the news and media, they will say these kind of things to you. So the amount of times that there's been predicted for a stock market crash, you can see it there. It's been many times over this incredible bull run that we've had. So the point is just here, people are afraid sometimes to put money in the market, especially when it's at an all-time high. But often what happens, you sit in the sidelines and you just see the market keep going up and up. The fact is that on a day-to-day basis, stocks, the stats are something like 53% to 47%. One day it can go up, one day it can go down. So if you're day trading, you're very much like a 50-50 whether or not you're going to be successful in the market. But if you stay in the market long-term, hold your stocks, that's how that you can guarantee success. So obviously this is even more so when we look at individual stocks. So when we look at our portfolios like Netflix, I've just cherry-picked one here, for example, because Netflix has been an amazing stock to hold for the last 10 years. So if you look at the last 10-year performance of Netflix, if you look at this chart, it's been amazing. You basically 50 times your money. $1,000 investment would now be worth over $50,000. So this is about as good as you can hope for as a stock investor, picking a stock like this. But what I showed you earlier is having that conviction of holding on to a business. If you believe in the business, you understand the fundamentals and the underlying business, even when that stock declines by 10 or 20%. So if we look at this chart, this now shows you again that same thing. How many times Netflix has been way off of its all-time high. So if you look at that 2012 to 2013 period, for about a year or 2 years, Netflix lost over 70% of its value. And it's lost over 30% of its value during that time frame, probably about 7 or 8 times. So again, it's very counterintuitive, for people to, how do you hold onto a stock like this? So for a lot of again, in the mainstream, the Wall Streets and the hedge funds out there, you don't see this, they don't hold stocks for this long period of time. And that's really the key differentiation to success. I mean, myself included, imagining holding a stock for 2 years that's down 70%, it's a very counterintuitive thing. It's a very difficult thing to do. But it's if you look at that, to get that 5,000% return, you would have had to endure some of these drawdowns with the stock. And inevitably you get into one of these cycles. You buy when the stock market is doing well, and you sell when the stock market is doing not so well because you're worried. So I just, I like to focus on long-term investing, so I always like to include just some of those things. But let's focus a little bit more on the portfolio itself. Earnings season is just basically almost behind us. We've had a huge number of our stocks reporting earnings the last couple of weeks. The majority, I think about 90% of the stocks have actually beaten or met expectation, beaten the earnings expectation. And if you just look at some of these stocks I've just highlighted, so these are some of the top positions that we hold by value in the portfolio that reported earnings now last week and the week before. So if you look at Trade Desk, year over year, 31% increase in revenue. So these are not looking at stock percentages, right? So this is one of the key things for me to look at. It's not, we're not trading stock tickers here, and I'm not looking at what the stock is doing one day to the next. If you look at Trade Desk, it's a fantastic business. Programmatic advertising is becoming a huge thing. I've followed the story of this company for quite some time. But if you look at just this year's performance from this last quarter's result versus a year ago, up 31% revenue. It outperformed this last quarter's revenue guidance by over 34 million. If you look at Shopify, it's even more crazy, right? So over 96% year over year performance. Roku 73%, Tesla and Twilio and so on. And I always like to look at these themes, obviously also look at playing out with the portfolio. So once again, if you followed me for a while, I'm very much into thematic investing, overall theme being artificial intelligence. Trade Desk is a huge proponent of that. We've got stocks in the portfolio, obviously like your Microsofts and Amazons that do artificial intelligence, but then you've got companies like Trade Desk that use artificial intelligence, so they use it for their programmatic advertising. So another theme we can see playing out here is Roku and streaming, but there's also some cross themes happening here. So Trade Desk, one of the biggest reasons why they outperformed this year is because of connected TV. So one of the ways they do advertising, what they do is they sell advertising in a programmatic way. So the big outperformance in their market segment has been connected TV. So devices like Roku, and obviously Roku, being a hardware manufacturer of a streaming stick, their biggest performance hasn't been the hardware sales, has been the ad revenue that they've generated selling on their platform. So it's just interesting to look at some of the fundamentals and the underlying reasons for why we invest in these businesses. And as you can see, this was a week ago's performance for most of these companies, some of the top holdings in our portfolio that's doing fantastically well. So for some of these companies, I think it's definitely justified. Some of the growth they've had, some of it's maybe a little bit overvalued. That's why we see some of the bit of sell-off. But in general, again, 3 to 4, 5 years out, these companies are still going to be fantastic winners in our portfolio. This is just a portfolio at a glance. So as you can see there, this is what a day or two ago. But I just wanted to highlight some of the stocks that's in the portfolio on the left-hand side. These are the stocks that's in the portfolio and the year-to-date performances. So, nobody can time and position these things perfectly, but you obviously try and pick the stocks that you think is going to have the potential to outperform the market, and we've picked quite a few very good ones this year. So Fiverr, I mentioned earlier, it's a small position still in the portfolio, but some of the other ones, as you can see there at the top, that all performed, that all returned over 100% this year. Some of the biggest positions in the portfolio, stocks like Trade Desk, 193%, Twilio, Nvidia, Shopify, those are some of the biggest holdings in the portfolio that all returned over 100% this year. So yes, this year has been a very good year. It's been a very unusual year, but it's also not just been this year. So I try and obviously outperform the market, the S&P 500, but also try and outperform the NASDAQ 100, which is kind of my benchmark. So NASDAQ 100 obviously being an index that tracks most of these top 100 technology stocks or non-financial stocks. And as you can see, we've outperformed it quite handsomely this year, but not only this year with the pandemic and everything going on, we've basically outperformed that index every year since I've been on eToro. This is the fact sheet that you can also see if you go to my portfolio. There's a link up there, and if you go to my website as well. So things have changed a little bit again since the end of October when this fact sheet comes out. So eToro releases this every month, so it's a very nice way of checking, trying to resist that urge of checking every day what's going on. Have a look at this fact sheet month to month, and it's a really nice way to see what's going on with the portfolio. So in terms of looking forward, I presented this last time. I love looking at this indicator. What this is they call it the PGI. So it's to one of the platforms that I've subscribed. You can have a look at this information. So what this means is the amount of money that's in money markets. So basically not in stocks. So what they measure, what you can see measured there is how that's changed for 2020. When we saw what happened in March, a lot of people obviously cashed out of the market, and you can see that chart going up. So traditionally for the last 10 or so years, that level has been around the 10% mark. But you can see a lot of people went back into cash, understandingly, when the March crash happened. But you can see now also that that trend has come down, so people starting to put more money back into the market as they felt more comfortable and as the market started rallying again. But obviously they lost out on a lot of this growth if you only started putting your money in back late in the market. Our portfolio, we were almost fully invested when the market crash happened, so we took the full brunt of it, but we stayed invested. So we also had the full return of the subsequent rally. But what's interesting to note here, and what I wanted just to highlight is, as we stand at the moment, as you can see, we're still quite a bit higher than where we were before March. So there's still quite a bit of money that's not in the market. So a lot of people are always worried about, is this a good time to put money in the market? So just purely looking at that statistic, it's obviously not a crystal ball, anything can happen, but it is a good way of looking at the market and seeing that there is still a lot of cash that's out in the market that's not been invested back in since we've now come out of the major issues with the pandemic. Obviously, we're seeing a lot of rise in the COVID cases again all over the world, especially in Europe and the US. But I really do believe that we won't see the same kind of market shock that we saw in March, right? Nobody knew what was happening in March. Now everybody's got a better idea of what's happening. We saw now there's news of a vaccine coming out. So I think, sorry, there's a lot of reason to be optimistic. Presented this last time as well, but just a little bit about the portfolio in terms of the strategy. The performance we've seen throughout since I've been in Toro, it's been achieved with not using any leverage. So if you're not familiar with leverage, basically you use a little bit of credit to supplement some of the returns. So you can make a much better return, but you can also obviously take a lot more bigger losses. So from a risk perspective, we are not using leverage. It's just, we're just buying and holding these stocks, hopefully making the right stock decisions, holding the best ones, maybe selling off some of the ones that not doing so well, or maybe taking a little bit of a profit of some of the ones that has really done well, and reinvesting that profit back into the rest of the portfolio. So as you can see there, they've also kind of made the point that make sure that not one stock is overexposed, more than 10% of the portfolio. And then also I like to always keep 5% in cash. So yesterday I also opened a few trades again. So some of these stocks like the Fivers and the Zooms that took a bit of a beating yesterday, good opportunity to reinvest back into those stocks. So I opened up, used some of that cash again yesterday. Adding cash in regular intervals, also always a great idea. I try and do that, especially during downturns. I'm not going to go through all of these, but just some keys to success in terms of my strategy and what's helped me succeed since I've been in Toro and before that. It's just obviously having the patience. Letting your winners run is a big thing for me, not taking profit. We saw that Netflix chart earlier. So if it was up by 200%, a lot of people would say, why don't you just close that position? But if the fundamentals are still good, the business is still good, we saw now it went from 200% all the way to like 5,000% over that period. So holding on to your winners, you're not going to get that return if you keep selling a little bit of it, So try and let your winners run. And yeah, of course, obviously it's impossible to predict what's going to happen in the future, but like I said, I think there's a lot of things to be positive about. The vaccine news is obviously good, even though in the short term might not be so good for technology stocks. In the long term, I think it's definitely a good thing to get somewhat back to normal again. So it's been a really interesting year. I think it's been overall a really fantastic year in terms of portfolio and growth. We've been on the right end of it in terms of technology stocks rallying. Some of the stocks we've had in the portfolio long before any of this happened, in terms of before we had the term stay-at-home stocks. The trend was already there, the technology was already going that direction. Yeah, thanks for the copy. Like I said, if there's anything, I always try and get back to all the comments as soon as I can. So if there's anything that we didn't cover today, please drop a comment in my feed page. I'll get back to you as soon as I can.